Hello there, my name is CryptoKeep, and today I want to discuss a quick topic of what market to trade between the forex market and the crypto market. I do hear a lot of people say that the cryptocurrency market is a death trap and that no one really can predict it. Some say they want to leave the market for the forex market, that the forex market is a way better market to trade, as there you won't witness much losses like they do in the crypto market. They say the crypto market is too volatile and one should be really careful trading it. About how Bitcoin can have a lot of 10% change in a day, and trading in the cryptocurrency market should be in one of the top 1000 ways to die. These are all the things some people and the media say about the crypto market, and they absolutely ignore the fact that it is in the forex market that we see about 70% of traders blow up their accounts on several occasions time after time. So, is the forex market a really better market than the crypto market? Or the crypto market is also the way to go? Firstly, I want you to know that trading is trading. No matter the asset you trade, no matter the market you trade in. I used to say this: if you buy an asset with hopes of selling it back for either profit or loss, you have done what is called trading. If you exchange an asset of value for another asset of value, you have simply traded as well. Now, the environment for the art of trading may be different. The regulations surrounding the trade may be different, but it doesn't change the fact that you have traded. And the fact that you have traded means you are trading. I swear, technical analysis is the same across all markets. There may be little difference of this strategy or method may work more in the forex market than in the crypto market, or this strategy may work more in the crypto market than the forex market. But know that no matter the strategy or methodology, it is still encompassed in the art of technical analysis. So what really is the difference between the crypto and the forex market then? Personally, I would say this is a matter of personal preference. Some people prefer not to trade the crypto market because they do not understand it. Some people feel it is too volatile for them, as they lose money too often due to the volatility, while some people feel there is high level of manipulation, as it is quite unregulated as of now, and the government can decide to go against it, and some people just don't know any better. The forex market is surely the largest financial market in the world, and the crypto market is just an underdog as of now. This means there is a lot of money in the forex market and less volatility, which means it is more stable due to the number of big players involved, and it means it has a very, very high liquidity. The likes of these big players include central banks, hedge funds, investment institutions, investment banks, and many others. Talking about the forex market, in a market where over 90% of the traders are institutional traders, all of them with large pockets. If one company places a bid of $20 million, another company can easily match that bid with an equal amount of supply or ask, which keeps the market relatively balanced, no movement. So, how will such a market be volatile when there is absolutely no much movement? This is where the power of cryptocurrency lies. People see the volatility of the crypto market as its weakness, but then that weakness is also the greatest strength it has. The greatest strength of the cryptocurrency market lies in its weakness. A market where you can easily put $1,000 and before you know it, you are in profit of 1,200 of and up to $1,500 in profit. That is why you have to learn how to analyze all these candlesticks, price action, either with the use of support and resistance, supply and demand, indicators, volume, or whatever methodology you know how to use well. Just make sure your bet is right, because trading is more or less a bet. You bet that the market will go up, and if it does go up, you make money. And if you bet that the market will get to this point and come down, and you place your money here, and if your bet is right and it comes down, you make money. So either way, up or down, you make money. Just make sure your bet is right. You can also do this in the forex market. But let's continue the topic, and we will get into detail very shortly. People do complain when things do not go their way, as we do know. When they take trades and make profit, they do not talk, they are silent. But the moment they start to lose some trades, then they start to complain that the market is so unpredictable. Nobody can really predict altcoins. Nobody can predict Bitcoin. Nobody can predict the cryptocurrency market, in short, just because they have taken 1 or 2 trades and they lost. Whereas they might have taken 5 trades in the past and they won. But then that time the market is good. But since they start to lose now, the market is unpredictable. Let us get technical at this point. Let us compare it like for like. I will use a forex chart and also a cryptocurrency chart. Let's examine the percentage change on the daily moves. The low to the high on this euro dollar. This is today's candlestick. Why on this ETH? This is today's candlestick. Each candlestick you see here represents the data from today, from 12 a.m. or 12:01 a.m. See this very moment. It is a daily candle here and it is a daily candle here. So let's see the price difference from this today's low to today's high here. Then we do the same for ETH. This very low to this very high. We want to see the price change in percentage. Okay. As you can see, the percentage change is 0.05, all within today. Now let's see for the ETH USD. We have 2.76%. Can you see the difference? Let's take a step backwards. Let's take a step back to Friday's data and take the low to the high. 0.50%. Let's do the same for ETH. 5.64%. You see the difference? Then let's do the same for even a day further, Thursday. The crypto market do not close on weekends, unlike the FX market. We have 0.48. Then let's do this. .69%. You see the difference here. The difference is a lot. Here we have an average of 0.05 to 0.5% in a day. 0.5% change in a day. It doesn't mean that it cannot go up to like 1%, no. Like let's see what is a change on this particular candle. You see, here is 1.29%. What day is this? 1st December. Okay, let me find 1st December here. Okay, this is 1st December. Let me see the difference from the low to the high. 13.52%. You see, when the forex market make a change of 1.29%, ETH made a daily change of 13.52%. Even though it's a bearish candle, but then we are doing the low to the high, right? Just for mathematics sake. As we can see, the ETH makes an okay percentage on average days. Like we see 2%, 5%, 5%, up to 13%. Whereas the euro dollar is just, the highest we've seen so far is just 1.29% on an average of maybe 3 to 4, 5 days. So the forex market is not as volatile as the crypto market. That is correct. Due to the high liquidity it possesses, and it's It's the largest financial market though, so you shouldn't be surprised with that. So what does this mean? This means if you put an amount of $1,000 at this low, if you enter an amount of $1,000 at this low, and you exit at this particular high, and you do the same at this low, and you exit at this high, the same amount, likes for like, right? How much do you think you'll be making? Here, you place $1,000, $1,000 at 1.21157, and you sell it after a price change. What is this price change? 0.5%. Let's do the math. Buy $1,000 here, sell $1,000 here. The profit is just $5. $5 profit. Whereas if you put $1,000 here and you sell at $5.95, how much will the profit be? Let's do the math. Oh, sorry, before then, let me see the percentage change. 5.64%. You make a profit of $56.4. You see the difference? Your profit on the Euro USD will just be $500. I mean $5, not 500, sorry, compared to the $56.4 on the crypto market. When you put $1,000 at those lows and you sell at those highs. And this profit margin is due to the volatility people complain of. But they will say the volatility that gives you high profit can also take you out very fast. This is where we go into zone trading, where we have a price at one point, our entry price at one point, then our exit price, which is stop loss, at another. Assuming we buy at this price level and we have a stop loss below this low. So once price retraces into it, we anticipate that it will rally back up, right? And then here, let's say we buy at this price high and we sell at this low. So if the price comes back into it, we want to be a buyer and then anticipate for that movement back up. So this line, the top line, will be our entry price line, where here we will have our stop loss. Here will be our entry price line. Here we will have our stop loss. So let me see that the percentage change, the percentage difference from the entry to stop on both pairs. This will be from here to the low, right? That's 0.35 percentage change from stop, entry to stop. And here is just 4.20. 4.20%. You see, because of the volatility on cryptocurrencies, the distance from entry to stop is wider than on the forex market. But looking at it like for like, which one looks easier that it will get taken out quickly than the other? Of course, I will say the 0.35% is very tight. It's very tight, tighter than the 4.2%. That is where people complain of the volatility on the cryptocurrency market, because you have wide stop here, and that doesn't mean you won't get taken out. Likewise here, because you have tight stop, it doesn't mean you will get taken out quickly. No. You just have to understand the market. If it moves from here at this particular price line where it is up to your stop loss, that is 0.71% negative. That's all the moves it needs to make to take you out of the trade. And we have seen, like we saw here, this switch candle, we have seen it make 1.2%. So it can also do the same. Let me see from this low to this high or this particular candle. This is also another 1%. So it can also, and this is a negative candle, which means a sell candle, which means it can also do the same and take you out in just one day. Likewise, the crypto market. We have days where the candles is just 3.4%, which means if you have to move from this current price line to this place, you need a 9% move. You need a 9% move from this current price to take you out of the trade here. Let us look at the monthly chart and see if we put 1,000 into both trades at the beginning of last month, how much we will make at the end of that same last month without using leverage. Let's see that. This is this month, December. This is this month of December. This is last month, and this is last month. So if we put a $1,000 at this very low, assuming we cut the very low, we bought at the very low and we sold at the very high. It's just a scenario, right? It doesn't mean you always catch the low and set the highs. No. What is the difference between of this move from the low to the high? The percentage difference. It is a 3.45% for the whole month. Euro dollar moved just 3.45%. That means if you have a $1,000 at this low and taking profit at this high, how much are you making? $34.5. $34.5 for the whole month with a $1,000 position size. Likewise here on the crypto market, if you're able to catch a very low and sell the very top, how much will you have made in a month? We have a 68.27% move here. That means in a month with this, you'll be making a $682.7 from the beginning of the month to the end of the month. I hear from the beginning of the month to the end of the month. So which market do you think is more profitable considering these scenarios? I will say the crypto market, of course. And why is this? Because of the volatility. The volatility that people complain of is also the greatest strength. Yes, you can be taken out if you are wrong, but then if you can easily predict that this market will go up and you place your bet on it and it does go up, it goes up heavily, which means it can give you a huge amount of profit. Whereas if you place your bet here too and it goes up as we see here, this candle is an heavy candle, but then the percentage change is very small. It is very small, and this is due to the large number of big players. We have over 90% of institutional traders on the forex market. So you may be asking, if the forex market is lacking of good volatility and hardly moves a decent amount of percentage, how come forex traders make good money off their forex trades? The simple answer to that is leverage. Leverage is the act of trading borrowed funds where you use whatever amount you have on your account as margin. So leverage is using borrowed funds to trade. And mind you, the lender cannot lose, but the trader borrowing the funds will take all the higher risk. Most brokers, they offer traders up to 500S of leverage, which means 500 times whatever you have. Some even offer you up to 1000S. I think the minimum they have is like 100S. This means if you have like $1,000, you can trade up to a position size of $500,000 by using the max leverage of 500S. If you are trading $500,000 position with this move on the month, which is just a 3.45 move, or no, rather, let me use it daily for this. The daily where we have a price change from here to the high, where it is just 0.5. If you are trading a $500,000 position with 0.5% change, your profit will be $2,500 just like that within the day. Is that not enticing enough? That is very, very enticing. So if you have a balance of $1,000, you deposit it on your broker's platform and you are offered the opportunity to trade up to 500s, which means with your full $1,000, you trade a position size of $500,000. And with as little as 0.5% move, you are making $2,500. That is a whole lot of money. What you won't be told is the fact that you are actually exposing yourself to a lot of risk. And if the price of this trade goes against you with just 0.2%, just 0.2%, like this, just 0.2% like this. If this market where you have used your $1,000 to open a $500,000 position size, with just 0.2%, your full 1,000 balance you have is a goner. What I mean by it's a goner, I mean to say your $1,000 is gone and should be liquidated because you are overexposed in the market. Overexposure kills a lot of people in the market. That is why you see a lot of people getting blown out of their accounts. Like I said, the minimum leverage I think most brokers offer is 100x. Some do 100x up to 200x, 500x. Some even do up to 1000x. So you can borrow more money to trade and the lender cannot lose. Once the position moves against you and your maintenance margin is in red, they will secure the borrowed amount. They cannot allow that to go in loss. Rather, your balance will be liquidated from 1,000 to 0 in 1 second, or in 10 minutes, or in 1 hour, depending on the time frame you are working with. Another thing is, the minimum position size you can trade on the Forex market is 1 micro lot, which translates to $1,000 position. I do not know if some brokers offer you to trade lesser than that, but the one I've seen is 1 micro lot, which is $1,000 minimum. So how come do we have people with $10, just $10, getting to trade and with their $10 and they are happy making money? If we do the maths, we have $10 by 100 days. That will give us $1,000, right? That will give us $1,000. That is why some people will say, some brokers will say, you can trade with a minimum amount of $10, where their minimum position size you can open is $1,000. So they are encouraging you to lose your $10,000 because I'm saying $10,000. I mean your $10, because by the time you deposit your $10 and you trade with a leverage of 100x, which gives you a position size of $1,000, actually in no time, you are taking a full risk here. In no time, you'll be liquidated. You'll be liquidated. You get a margin call, and then your $10 is gone. So what is the solution to this? The solution is risk management. Risk management. If you manage your risk well, either in the Forex market or in the crypto market, you can have a balance of $1,000 and choose to only risk 1% of that $1,000, which is just $10. So let's assume that you have your entry here at this point, and you have your stop loss here at this low here. Likewise, you have your entry at this point, and you have your stop loss at this point, 4.2, whereas this is 0.35 distance to stop. If you are using risk management and you are risking 1% of your $1,000 balance, which is just $10, if you lose on this trade, no matter the distance, you are losing just $10. And if you lose on this 4.2% as well with your risk management, you also be losing the same amount of $10. So why can't we just take our risk management seriously? You may think the crypto market is being manipulated. So is the FS market as well. But in most cases, where people see manipulation in the crypto market is when there are huge wicks, like we have here. We have a huge wick here from this candle low. But what of this too? Is this not a new week down? If we keep looking, if we keep seeing all of this. But then in the crypto market, yes, it's highly volatile. But then people forget that some people do take over leveraged positions. Someone with $10,000 can decide to go all in and take a position size of $1 million. Yes, using 100S with $10,000. That's $1 million position size. Just because they heard a rumor or a news that the market is going to pump very hard and they wish to buy Lambo the next day. So they want to risk all the $10,000 they have to take such a highly leveraged position and make a lot of money from it. Taking such huge amounts of position will definitely move the market depending on which coin you are trading because of the lesser liquidity we have in the crypto market compared to the forex market. So the $1 million position might move the market. And then when big players also get involved and take a counter trade of that person's trade, the person unfortunately gets liquidated, what do you think will happen? You will see a big sell-off due to liquidation, not necessarily because people are selling. You see a big sell-off due to liquidation. And remember I said when I was talking about smart money that we have some different types of buys. We have the profit taking, we have the intentional buy, we have the profit taking. Also, buying due to stop loss when you buy back. So when you also liquidated, depending on the direction, it's either a sell order or a buy order. So you see a huge move up when the person buys to push the price up, and when people start selling, seeing an opportunity to sell, and then the price gets pushed down, and once it hits its liquidation price, and then you see another huge big drop down, then you say the market is being manipulated, whereas actually it is somebody taking an over leveraged position and disrupting the whole market. That is not to say there is no manipulation, no, but this is what happens most times. This means you must understand the market that you trade in and know the likely decisions of other traders. When you are thinking ahead that some traders might take a very large position, so you want to be proactive with either placing your stop loss or taking confirmation entries. So in short, plan your trades and then trade your plans. Risk management is very essential to prevent you from unwarranted moves. And when you are taken out of a trade, reassess the trade, reanalyze the trade, know what happened and why you have been taken out or stopped out, rather than just conclude that the market is taking you out due to smart money manipulation or something, and then that no one can predict the market. It shouldn't be so. The forex market can also take you out the same way smart money will take you out on crypto. It happens everywhere. You just have to understand this market. This is what goes on. This is what can happen. This is what other traders can do. And you better prepare yourself for it. Crypto is a more technical market, whereas the forex market is technical as well as it is fundamental. This means you have to do a lot more work while trading the FS market, because you have to have your ears on ground for economic details of the countries you are trading their currencies. Like you have unemployment data when they come out, what is it start saying, the GDP of the country, and a lot more things. Global news, elections, all those things do affect, they play a major role in the FS market because you are dealing with a centralized currency owned by countries, and whatever happens in that country will surely affect their currency. Look at the economic instability and recession in Nigeria. Look at where the naira is to the dollar today. So such things, you want to be proactive with all those fundamentals in order not to just go fully technical and then the GDP comes out, or the unemployment rates or interest rates or some other things, and then the whole market just goes against you. That is why you have to understand the market in which you trade. So to me, no market is better than the other. Basically the same thing, but one requires more work than the other. And you just have to plan your trades. That is all that matters. Have a calculated amount of risk you are taking. Plan the trade and trade the plan. High volatility or not, you'll be fine. And if you think because you are always wrong on trading the crypto market, you cannot be wrong on the FS market, then you are still wrong. If you are wrong on the crypto trading, you can be wrong on the FS. Even in stocks, you can still be wrong. So plan yourself well. Find a strategy that works. Learn technical analysis and be comfortable with it. And also, know that no strategy is 100%. And technical analysis is not an exact science. Just an art of drawing lines and boxes on a chart to predict movements. So know this, and then you'll be fine. Thank you for listening.